The terms asset and liability are often thrown around when talking about modern economics. But what is the definition of each? How can we limit the number of liabilities that we own? And what are the most profitable assets? In this video, we will cover all of these subjects and why they are so important for growing wealth in the modern world. If you are interested in building assets and accumulating money through investments, you're in the right place. Defining liabilities and assets. Liabilities and assets are distinct concepts. However, many people often need help to see the difference between the two. In financial accounting, an asset is anything that one can use to make money, like owning stocks that increase in price. Assets may also be referred to as investments that may result in a quantifiable return on an initial investment. For example, purchasing exchange-traded funds, ETFs, shares, and bonds count as asset acquisition because they generate cash in the form of dividends or can be sold for a profit due to capital gains. Many people think buying a house is buying an asset. However, if you plan to keep it for a long time, it cannot be considered an asset, as it will become a significant liability that will drain your finances for years to come because of the monthly mortgage and the maintenance costs you'll have to pay. Paying these costs is not putting money in your pocket. That said, the property could be seen as an asset if you intend to sell it again for a greater price in a shorter period of time. A liability does not put cash in your pocket. A good example of a liability is vehicle ownership, because the price of a vehicle reduces drastically after its purchase. Because of this, second-hand automobiles are liabilities as they are worth far less than new ones and do not make you money. Naturally, there are certain exceptions, such as vintage or rare cars, whose value might increase. But we are talking about your average cars that people buy for personal use every day. Defining tangible and intangible assets. Have you ever heard the terms tangible and intangible assets? If you have, you might be wondering, what is the distinction between tangible and intangible assets? Put simply, you can touch and engage with tangible goods as they are real things. Tangible assets are things like land, real estate, artwork, cash, and inventory that you can touch or see. Intangible assets are things such as online content, patents, software, and trade secrets. People often confuse tangible and intangible assets as if they were the same and produce the same profit. But this is not the case. To elaborate, tangible assets are real assets that have an inherent worth, which is why they are referred to as real assets. On top of this, they are unaffected by market forces. This is opposed to intangible financial assets, such as stocks that use the market trading price to define their value. These constantly moving prices can result in paying more for something that it is worth. This is also why stock market experts like Peter Lynch frequently discuss the importance of researching a company's value so that you can determine if a stock of it priced fairly compared to its actual value. Before we continue into the best types of assets to have, we hope that you're enjoying the video and find the information to be valuable. This subject isn't easy to understand, so rewatching specific parts might be beneficial. If you're ready to continue, here are the most rewarding assets to possess. Some of these might surprise you. Real estate as an asset. Real estate property can be considered an asset in some circumstances. Remember, owning a home for life without the intention of selling it is not an asset. It's a liability. However, there are real estate investors who invest in underpriced property with the intent to resell or rent it. In this case, it becomes an asset. This sounds straightforward in theory, but isn't effortless in practice. Finding an underpriced property is challenging, and considerable effort is needed to fix whatever issues are causing the property to have a value below the market standards. However, when executed well, this can result in a good return. An introduction to stocks. Stocks are the most well-known assets, and they offer enormous potential for those who understand how to invest in them. For a better understanding of the concept of stocks, take this example. Imagine owning a piece of land within a city, and your ownership of this piece of land gives you some input on decisions within that city. Furthermore, if the city grows and increases its financial standing, the price of your land will increase too, as the demand for land in that city grows. In our example, a piece of land can be compared to buying a stock. Stocks, also known as shares, are a fraction of a company. When you buy a stock, you buy a very small percentage of that company. If you have enough shares, you own enough of the company to have voting rights when the company makes significant decisions. As in our land example, if the company value increases, so does the value of your stock. There are two primary ways to profit from stocks. The first and most common is capital gain, which is when you buy a stock, wait for its price to go up, and then sell it. For instance, if you buy a stock for $15 and sell it for $25, you will make a profit of $10. However, stock prices constantly fluctuate. Prices can go up and down depending on the market supply and demand. The higher the demand, the higher the price. To the untrained, stocks can seem like a gamble. But if you know what you're doing, carefully consider the businesses you invest in, and invest for the long term, you should come out ahead. The second way to profit from stocks is through dividends, which are paid semi-annually, quarterly, or yearly. Dividends are your share of the profits made by the company, and you are paid in proportion to how much stock you own in the company. The more you own, the more you will receive in dividends. If this investing in stocks sounds interesting to you, you might want to talk to your bank about the services they offer for investing in the stock market, or open an online account. The highest valued and the least appreciated asset. Finally, and most importantly, knowledge and experience are intangible assets. These two crucial resources are often underappreciated. Learning and applying that knowledge to your future financial decisions and business ventures will help you navigate to success while avoiding potential setbacks along the way. Your knowledge will accumulate over time, and as you grow in experience and make connections with others, allowing you to achieve even greater success. This makes your knowledge and experience the least appreciated, but likely the most valuable of all assets mentioned. Conclusion. Sometimes the difference between an asset and liability is not apparent. Hopefully, the information in this video has helped you understand the difference. For smart investing, knowing what types of assets to hold and liabilities to avoid is essential. Finally, while stocks and real estate are both fantastic markets with opportunities for profit, it is critical to thoroughly research potential investments and devote sufficient time to each to make an informed decision. If you are willing to learn, work hard, and use your time wisely, it will always pay off eventually. We hope that you enjoyed this video. If you're interested in learning more about finance or what it takes to be successful, check out some of our other videos on our channel. Thanks and have a great day.